We are spending $38 million in Plano, Texas right now to buy real estate. And whenever you drop that kind of money, people ask, why now? The question is commercial real estate dead? The media wants you to panic, but if you actually look at the institutional data and what's being built right now, the Dallas-Fort Worth Metroplex is being primed for a major surge coming. Institutional money is quietly pouring millions of dollars into Plano, Texas, and the landscape of the city is about to drastically change. Today, I'm gonna take you behind the curtain and show you exactly what's about to change in Plano, Texas in 2026, and why we're investing $38 million into this market that's about to explode. Right now, a $4 billion project called the Texas Research Quarter is being built in Plano. They're turning a massive 135-acre campus into a world-class medical and tech hub. And with the first buildings opening right here in May of 2026, this is gonna bring thousands of new six-figure jobs to the city. When we see massive capital flowing into these submarkets where you've got these very large companies employing high income earners, what that does is it puts strain on the units, the apartment units, and the entire community. You've got this massive amount of pressure that comes into the market, and there's not enough new supply to fill that pressure. Think of it in simple terms like a pizza. If it's just you eating the pizza, there's plenty. Now you add 2 or 3 people and you got to start to divide the pizza up. You add 8 or 10 people, you might not even get a slice. That's exactly the same scenario that's happening when these major new companies open up and bring in all these new employers. It puts pressure on the supply-demand imbalance. And what controls rent more than anything is supply and demand. So for us, when you see these new medical buildings opening, you're gonna be predicting that there's pressure on rent. The piece you wanna be careful of is to still not over project the annual rent growth that you're gonna see in these submarkets. The way people get smoked is they think they're gonna have this huge increase of rent every single year, and then they underwrite for that, planning for these big rental increases. You know, the people that got wiped out or had the most challenges for deals that were bought back in 2021 and early 2022 used these rent projection growth numbers that were very similar to the last 12 or 24 months, and then the market shifted. So what you want to be careful of is, even though there is massive supply pressure coming, there's not enough new units being brought online in a 2-mile radius. So like, for the deal we're buying right now, there's no new units for the next 2 years within 2 miles. So we know there's no new supply coming, but we know there's more people coming. You still want to use conservative rent growth in hopes that you can overachieve, that you can over predict. So if you can use 2 to 3% rent growth and you don't have to use any more, and then you start getting 4, 5, 6, or even 7, now you're going to overperform for your investors. So the biggest key is still be conservative, even though it's very likely that you're going to have larger rent growth than what you're projecting. That's how deals win long term. So Plano is actively tearing down old infrastructure, like the Collin Creek Mall, and they're gonna build a $1 billion walkable neighborhood. Those are institutional developers. They're spending massive money. They're here to turn Plano into a premium destination with these parks and high-end retails. Yeah, when we're doing due diligence on this deal, you guys, we're driving the submarket. We're gathering this data. We're seeing these massive regentrifications of, these old malls. That just tells us the future of these submarkets is extremely strong. When we're buying a property that's got a Whole Foods or a Williams-Sonoma, Starbucks, Trader Joe's right across the street, all of those companies did massive market research before they decided to put their location in place. And so when you have that, that's a huge telltale sign of what that market already has to offer for the residents that live in that submarket. And then when you see these institutional funds dropping billions of dollars to revitalize the city's infrastructure, they also see the future, and it's gonna also compound and attract more people that wanna be there. People wanna live in these beautiful, well-kept cities. I mean, just think of it for yourself. If you're going through a city and you can live in a beautiful city that's got all brand new retail and it's safe and clean, or you're in a really dirty, unsafe market, you're gonna do your best to get into that premier market. And so that's why if you can buy real estate right now at these discounted prices compared to where the peak was back in 21 and 22, and you can find distress in the market. When I say distress, I mean that these sellers are being forced to sell. Quick recap is a lot of these buyers that bought back in 2021, used 5-year bridge debt or variable rate debt. And here we are 5 years later and they're being forced to sell. And that's the scenario we have right now and why we think it's such a unique opportunity to be buyers, because you're getting these A+ premier locations at very steep discounts. You know, we're almost $8 million less on a property we're purchasing today compared to what the seller paid 5 years ago. So if you can get those types of locations at or near the bottom of the market, we think it's just a very unique time to be able to scoop up some of the best assets we've seen in at least a decade. By the way, if you're an accredited investor and you want to learn more about what we do, the link's in the description. Plano, Texas already has a massive corporate presence, including the headquarters for Toyota, Frito-Lay, JP Morgan Chase. Because of this, the median income within just 1 mile of our new property is over $105,000. However, the average home in that submarket costs around $800,000. Even though the 1 mile median household income is over $105,000, it's still not enough to be able to buy a home that's $800,000, $900,000, or $1 million. It just doesn't work. You know, you go to a bank and you see what you can qualify for, it's just not enough income. So what ends up happening is a lot of these folks want to be in the submarket. They want to be going to the top rated nationally ranked schools. They want to be able to shop at the beautiful retail. They want the safety of these submarkets. So a way that they can still get into these submarkets and be able to enjoy all of that beautiful scenario I just described there is to be able to be renting an apartment. So instead of buying a home and having a mortgage payment of $5,000, $6,000, $7,000 a month, they can get into an apartment and pay $1,400, $1,500, $1,600, $1,700 a month. And now their children are able to go to the best schools, the nicest retail, the nicest parks. And so it is a barrier to entry that these submarkets create over time. And so if you can't afford a home, this is a way to be able to get into the submarket. And what we found when we did our lease audit, we do 100% of a lease audit, meaning we check every lease to verify income, expenses, to verify who the person is that's living there. And we can see how long they've been in these apartments. And a lot of these residents have been in these units for 6, 7, 8, 10, 15 years. And that just tells you that these locations are extremely rare. And when you get a lease, it almost locks you in or guarantees you a longer term tenant with less turnover, which helps your NOI and helps bottom line tremendously. Because interest rates spiked a couple years ago, developers completely stopped building new apartment complexes. And there is a 2-year lag in construction right now, which means in 2026, there's basically 0 new apartments being built within a 2-mile radius of the property. Yeah, so a little more history, you guys, because if you're gonna study the future, you gotta look at the past. You know, when rates were so low back in 2020, 2021, and early 2022, there was a huge glut of new supply that was started. And it took a couple years to bring that to market. So by 23 and in 24 and early 25, there was this huge wave of new supply. And that new supply takes time to be absorbed. You know, imagine a whole bunch of new units coming online. All these residents are going to go out and shop around to find the best opportunity to live, the best price with the best amenities for the best service. So that took place through 23, 24, and 25, and that brought rents down. That brought vacancies up. And at the same time, you had rates rise. So when the rates rose, it brought values down even lower, and it stopped the new construction wave. So in 24, 25, and here we are in 26, it became very expensive to build new units. And because rents were climbing so quickly and then the new glut hit and then rents came down, people stopped building. So you went through this huge wave of new supply, 23, 24, 25, and then a very limited amount of new supply got started and is being started right now. And so you can see in the chart, the data shows it. We can see it clear as day. 2026, 27, 28, and even into 2029, the amount of new units coming online is extremely small. It's extremely limited, especially compared to 23, 24, and 25. And so when that happens, you're gonna see vacancies come back down. You're gonna see rents come back up. And especially if you can get into these submarkets where there's no new supply coming for the next 2 years and you have occupancy already at 94, 95, 96% occupancy, that's extreme pent-up demand. That is gonna put pressure on rents, especially for these A+ locations where everyone wants to live, with the A+ schools, with the A+ retail. It is gonna put pressure on rents, and it is gonna drive net operating income and thereby increase value. And a quick note is $1 $1 of NOI increase divided by a 5 cap is $20 of value on the exit. So for these larger deals, a 229 unit deal, $38 million purchase price, if in a 5-year period we can drive net operating income by $1 million on the exit at a 5 cap, we've got $20 million of value creation. That's the superpower of multifamily right now. When you see this amount of money being poured into a city like this, buying an existing cash flowing asset in that location is not gambling. It's a calculated institutional play. If you're an accredited investor and you want to stop paying 40% in tax and you want to start seeing cash flowing deals just like this, scan this QR code or click the link in the description below to schedule a capital positioning call with my team. We will look at your specific situation and see if you're a great fit for Granite Towers Equity Group's portfolio today. See you on the next one.